Nick Keegan, welcome to Acquiring Minds.
Thanks, Will. Great to be here.
Nick, your story is a bit different than our usual. You started your business as opposed to having bought it. However, buying a business later in your journey and the pivot that represented was key to the very impressive growth that you've enjoyed since. So I think it's fair to say that Male Metrics 2.0, if you will, is all about entrepreneurship through acquisition. Mm-hmm. We'll get there. Start us off, please, Nick, with some background on you, and then we'll turn to the origin story of Male Metrics and go from there.
Sure. So, look, it's great to be here. I suppose in terms of a bit of background from myself, this is my first business. Started this business when I was 24. Prior to that, my goals and ambitions, I suppose, was to join the Irish Defence Forces. I aspired to be an army officer and was working towards that goal. I had joined the Army Reserve and served 11 years in the Army Reserve, so my career path was firmly going in that direction. But had an idea for a business with a friend of mine, which became Male Metrics ultimately. And the way the Irish Army recruitment works is they have a recruitment competition once a year, and quite difficult to actually get into, believe it or not, because it's such a small country and they only accept so many people. So between competitions each year, you'd be trying to figure out what you do with the next year of your life. And we had an idea for this business, and we said let's do this and play around with it for the summer and see where it goes. And my life just went on a totally different trajectory.
And we're about to hear about the business, but to be clear about you personally, you were not what we would call over here like a lemonade stand kid. You didn't have an entrepreneurial bent that had been demonstrated before. You aspired to be a military man.
It's funny actually, because I looking back now, I did, but I probably didn't realize that at the time. So when I think back to my childhood, I would have been the kid out with the lawnmower, knocking on doors to cut people's grass or washing cars or whatever it is. My father was an entrepreneur. My father was also in the military, but after that became an entrepreneur, a successful entrepreneur in his own right. And I'd often have business ideas, right? So, it'd be a great business, and I'd go and chat to him about it, and he'd tell me why that's a terrible idea or not, as the case may be. But I never actually identified in myself that was entrepreneurial traits until now, when I look back and I see that now,
Mm-hmm. Great. Okay. So what was this idea that you guys figured you'd play around with for a summer or a year between trying to get into the military?
Yeah, like absolutely totally naive, right? That we could do anything in a summer. But we had an idea for a mobile app, and this was around 2013. And we thought it was a bit of a pain when you first move out of your home and you're getting your first apartment, or you're renting for the first time. You have to manage all these household bills. So you'll sign up for internet, gas, electricity, TV, all utilities, etc. And in order to get all of your bills, you needed to log into your phone provider to get your phone bill. You'd go to your bank, online banking, to get your bank statement. And that was just a bit of a pain in the ass. So we said, what if we had one app on your phone which could take a feed from all of these providers and essentially consolidate all of your online bills and statements into one easy to use app? So it's like a consolidation play around your online billing, essentially. Mm-hmm. Mm-hmm. So we decided, let's just give this a go and see if we can make a go of this. And one thing led to another, and somehow over the next 2 years, we raised 700,000 in seed funding, hired a couple of developers, and started to build out this app. Now, ultimately, it was an absolutely terrible idea, and it totally flopped.
It has a lot. I mean, intuitively, I'm like, yes, I have that problem. I have all these sites I need to log in to, some of them, utility businesses running these horrible websites. So, would love to have a centralized feed of this stuff.
Yeah, people still say that to me to this day, and say, "Is now not a better time to give that a crack?" But genuinely, it's a terrible idea because it solves your problem as a consumer, and that's the angle that we approached it from. We were trying to solve a problem that we had, but believe it or not, we never really considered who owned the problem actually, and who was going to pay us for this service. Because whilst you might say it'd be really convenient to have one app where I'll get all of my household bills, you probably wouldn't pay for that.
Right.
At least very much. You wouldn't pay very much for it. And so we were trying to build a model whereby the utilities and the banks would pay us. And our hypothesis was that because it was so difficult to manage all of these different online accounts that you have, if you had one place to register, these companies would experience higher adoption for digital billing because it's just made easier. And that was our whole hypothesis.
And so that was their incentive. They in theory, they would really like this path to converting more of their customers to digital billing.
Yes, because it's cheaper than sending bills through the mail.
Yep. Boy, will that come back to play a role.
yeah, exactly. But we thought this was such a good idea, so revolutionary, that we shouldn't tell anybody about it, right? Because somebody will steal it. So we went and built this product in stealth mode, effectively. And then once we had a minimum viable product, we basically started talking to the utilities and the banks, and they were like, well, we'd never use this because we don't want anybody going to your app. We want them going to our app where we can upsell and cross-sell. And we don't want to lose that relationship with the customer by putting the third party in the middle. And we were like, oh shit, okay, we never thought about that. And there was other companies that made that model like successful, if you want to call it that, in terms of they got like hundreds of thousands or millions of users signed up. But their model was different, whereby you as a user would give all your usernames and passwords and they would scrape the bills and consolidate them for you. But ultimately, they could never really generate any revenue. So we were trying to come at it from the other way, where arguably there was a better business model because the companies would pay us, but they just didn't want to entertain that.
Yeah.
So we were pretty much the first 3 years of the business, we were trying to make this. We were flogging a dead horse, basically trying to make this work. And we just couldn't get it off the ground until we effectively pivoted in the direction of where we're going now.
And so did you spend down that 700,000 euros?
Yeah, pretty much. Like by the end of year 3, we were running on fumes. So we were really on death's door. The business was going nowhere fast. We had hired a relatively small team, like maybe we had 4 people working, three or four people working for us, including the 3 founders of the business. So I founded the business with a guy called Marcin Jernas, Polish guy. He's the technical brains behind the operation. And then his brother, Pavel, joined us within the first year as a second technical co-founder. So when we hired the team, we hired them out in Poland because the cost of employing FTEs out there was a lot of the big arbitrage between Ireland and Poland at the time, which has changed a lot since then. But we had maybe 4 employees working under us, and ultimately had to let all of them go except one developer towards the end, just to keep some cash in the bank.
So what was the kind of the inception here of the new model of Mailmetrics 2.0?
Exceptionally good luck, I think. I have to be honest. I'd like to think that we went away into a quiet room and took out a whiteboard and came up with this fantastic idea. We tried that a couple of times and we all just argued with each other and couldn't agree with just the direction we should go. But because the idea was novel at the time, we had managed to get an audience with most of the big banks, insurance companies, utilities. Because we were young and we had an interesting idea, they'd meet us and then, ultimately tell us that they weren't interested. But we managed to get those initial meetings set up. And then it was 2015, so we're into year 3 now. And literally, we had no customers. So I'd come into work on a Monday morning and I'd have nothing to do, right? Very, very difficult time. my phone rings, and it's a big insurance company, big British insurance company, but with operations in Ireland. And they said, you came in here maybe a year and a half ago selling some digital communications app. We have an RFP, like a tender coming to market. Basically, they said they had a mail room in their basement where they printed and mailed millions of policy documents every year to their customers. They had no means to communicate with their customers digitally. So they were going to look for bids for a company that could take over that mail room, get it out of their premises so that, they didn't have this sort of big printing operation in their basement, and then sort all that out so the right documents were going to the right people, because it was a bit of a mess. And they were having regulatory fines and breaches because they were sending the wrong documents out. And then they wanted somebody that could help them to digitize those communications to give their customers more of a digital journey or experience. And they said, remind us, is that the kind of thing you guys do? And I just said, that's exactly what we do. And we just pivoted in that direction, basically. So we told them that we wanted to go for the RFP. And because we literally had nothing else to do, we just poured our heart and soul into writing the absolute best tender response we could. And this contract, whilst it was a lifesaver for us, luckily was probably less interesting for some of the larger incumbents. So they probably just treated it as any other bid, whereas we really went out, fought for tooth and nail, and ultimately won that bid.
And Nick, when you say incumbents, what did some of the incumbents look like? What is this industry or this category?
So we describe ourselves as a customer communications platform. So we're a software platform for digitizing sort of regulated customer communication. So your bank statement, your insurance renewal, all those sort of key documents that your service providers will send to you. Our industry is, you can look at it in two silos. You have the very essential but more traditional side of the business, which are sort of large, almost BPO, business process outsource providers that have a secure print facility where all your bank statements and so on are printed and mailed from. More often than not, the bank doesn't actually send you those directly. They've given that to a sort of highly certified, secure print provider. So this is very different than, printing a takeaway, a menu for a food takeaway or anything like that. It's high security, a lot of technology and data involved, but ultimately, your banking transactions end up on a piece of paper. They're stuffed into an envelope in a fully lights out automated process, and it goes out the door through the USPS, for example. And then on the other side of the spectrum, you've got sort of technology providers that provide digital communication solutions or document composition, which is essentially the process, mail merge, if you're familiar with the mail merge process, taking a database and merging it with a template. So the incumbents that I refer to are more on the more legacy side of the business, these kind of large, what we call transactional print businesses. So that's who we were competing with. Whereas we were technology guys, we were a software business. So we came at it from quite a different angle, I suppose, which was the key insight for us when we won that tender.
I doubt I'm the first to point this out, Nick, but that if there's a classic business story from Techland where Bill Gates is talking to IBM and they want an operating system for their new PC. I think this is the origin of MS-DOS or BASIC or something. And he says, "We got it. We'll provide it to you." And then, of course, he had nothing. And scrambled, the team at Microsoft scrambled to deliver that. And it ended up being, of course, the deal of his lifetime because it got the distribution onto these PCs. And he retained all the rights to the software, having the insight that software was going to be more valuable than hardware, which was a big insight at the time. I digress. But it sure does feel like when opportunity knocks, you just say yes, sort of vibe.
I'm big into that, right? You kind of say yes and you figure it out after. And I don't think there's ever been a time where we have sort of sold the dream and not delivered in the end. So I think it's important, if you're taking that approach, you have some kind of confidence in your ability to deliver, of course. But opportunity fell on our lap. We just knew that we could do a good job here.
Yeah.
We just went for it. And
you were also desperate. You were also operating from a position of desperation. So you kind of,
absolutely.
This was a kind of a Hail Mary.
Within 6 to 12 months, we would have been out of business. You often hear those stories and say that makes for a good story, but it's the truth. We'd no customers, and we'd raised 700 grand, 2.5 years or 2 years prior. So we're running out of cash pretty quickly. So we needed this contract, and we had some technology developed from the previous business. It wasn't like we were starting from scratch, but we effectively designed the system that we wanted to build to solve this particular customer's problem. And we sold that like it was already fully formed, fully functioning. But we knew that we had a transition period. We structured the project in such a way that we bought ourselves some time for the technical delivery elements of it. And we just gave ourselves enough time to build a minimum viable product that would meet the customer's needs. And then we knew we could iterate from there. And that's exactly what happened. Ultimately, we won the contract, and within, I believe it was 16 weeks, we had the customer generating revenue. And these are pretty sizable contracts. So at that one contract alone, we were still loss making, but it was enough. We were generating enough cash to keep us moving,
Mm-hmm. Mm-hmm. And so that you said within 16 weeks. So now we're in late 2015, 2016?
Yeah. So 2013, 2014, no revenue. 2015, about 140,000 euros billed, but we didn't start billing until, Q4. I can't remember exactly when, but
yeah.
So as we go into 2016, we probably made 400 grand in revenue.
Okay.
And for a business with, 4 or 5 people, that was okay,
Yeah. Yeah. And so then at this point, the business model is what you described. So what is the business? Yeah. This is kind of, this is maybe your acquisition is kind of Mailmetrics version 3.0. I kept saying 2.0, but there's this interim period now from kind of 2016 where you're doing a what? Say it explicitly for us again.
So maybe I'll just elaborate on that. So Mailmetrics as a business was set up to be a technology platform that would take data from an insurance mainframe system, for example, and it would create all their documentation, all their personalized insurance renewals, policy documents, and distribute them electronically to their customers. So you'd log into a portal and you could see the PDFs of your insurance documents, or you'd get an email with an attachment. And you were able to sort of track all those communications, make sure they were delivered to the right person at the right time and they were compliant. However, a lot of people don't want to receive digital communications, or they just don't engage. And so you need to send them a letter through the mail. And we didn't have any capability to print and mail a letter. So we partnered with a printing business, one of these incumbents that I mentioned earlier. And anything that couldn't be sent electronically was sent to this print business. So effectively, every outbound communication that left this insurance company, whether through digital or print channels, was routed through our platform. And we outsourced the printed element to a third-party printing company. That's essentially what the platform did in the early days. What that gave to the customer was it allowed them to outsource a non-core activity. It allowed them to save money because we could do it better, faster, more automated. And by digitizing a higher volume of their outbound communications, they saved a lot of money on postage, effectively stamps.
Mm-hmm.
So that was the model. And once we won that first customer, we thought, okay, well, maybe this is the business, and maybe we can replicate this across other insurance companies.
Okay, great. And so this now is a business model that is working. You double down on it. You get more such customers. Take us over the next couple of years, and also specifically the trajectory of revenue as you grow into this or on this model?
Sure. So probably about 400 grand in revenue in 2016. That would have increased to 520 in 2017, 670,000 in 2018, and that's when we became profitable for the first time. Now, I'm talking like 4,000 euros profit, but we were profitable.
And paying yourselves as founders, paying yourselves salaries?
Yeah, but like very, very poorly. We were arguably the least paid in the business. I don't know, were we paying ourselves 30,000 euros a year or something like that? So yeah, look, we weren't making a lot of money from this, but finally we were starting to see some growth. And then it was 2019 was a big milestone for us. We did 1.3 million in revenue, so we nearly doubled in that year. And we did maybe like 100 grand net profit. So I suppose it was we were growing, but it all felt very slow because it was 7 years to break 1 million in revenue, right? So
yeah.
we certainly weren't a rocket ship. Like, we were written off by everybody. I think our early investors were probably not too excited about getting a return from the business.
Yeah.
But I suppose it was a big milestone for us to break a million in revenue. 2020 then we nearly doubled, so we got to 2 million in revenue, doubled earnings to 200,000. So it was growing at a steady enough clip.
Well, hold on there, because the doubling in a single year, that sounds like acceleration. Like, that's quite promising.
Yeah, but our customers our customer contracts are pretty large. So that doubling was probably one contract that we won. Because of the types of communications that we're sending, these companies are pretty cautious, right? They don't just give it to anybody. And we needed to build credibility over time to really start to be taken seriously. And the more customers we won, even if they were smaller customers, we started to build credibility over time. And so it'll get to the point where you'll win a slightly bigger one and a bigger one. And to the point where we're at now, where we can pitch for the largest banks in Ireland and the UK, and it's not a problem. So we may have won one contract that allowed us to kind of level up to that extent, but we may not have had predictability of where we were going to go the next year, So we had a model, it worked, we had customers that were happy, but we probably didn't feel we had a sort of scalable, repeatable business model at that point, because customer acquisition was just so hard.
Yeah.
Due to the regulated nature and the conservatism of the customers.
Yep. So now we do pivot into the real pivot. Let's hear how that unfolded.
I mentioned earlier in the story that we partnered with a printing business to manage the print element of the communications that we're sending for our customers. And we had set that deal up terribly because, again, like, we'd no experience. We didn't really know what we were doing at the time. So we would go and win all of these contracts, and we would just arrive to this print partner of ours and just give them all the print work. And they were making cream off the back of this relationship, and we were taking no commission, nothing. We just never even considered that. We just thought that this was a problem we need to solve. We need someone to print these letters. But if you think about a bank that mails 100% of their communications, day one when we onboard that customer, all the revenue is coming through the print side, and we're giving all that away. And it takes time for us to get the digitization percentage up for us to start to make some money.
Wait, what do you mean there, Nick? Because all of their customers are currently doing paper, and over time, you'll convert some subset of their customers over to digital little by little by little, and only as you do that do you guys start generating revenue.
Well, that's how the model was when we first set it up.
Yeah.
So the print guys would get the print portion of the contract. We would get the digital portion of the contract. But as you say, if a bank is pretty legacy and they send 100% of their communications through the mail, like, we made some money, but the lion's share was going to these printing partners of ours.
Okay.
So we quickly realized the error in our ways, but we'd set this contract up in that way. We had a number of large opportunities coming down the line, like really big contracts. And we realized that a lot of the value from those contracts was going to go to our partner. And I started to think, maybe we should own the print capability ourselves. So we bring the print and the digital together. It's sort of, we don't have a subcontractor on our contract, which they didn't like either, who's ultimately responsible for all this. It solved all those problems. So I started to think I should acquire this printing partner of ours, and started to figure out how I would go about doing that. And the rationale was twofold. On the one hand, it was to solve the problem that I mentioned where we were giving a lot of value away. But on the other hand, we struggled with customer acquisition because it was difficult to convince these companies to outsource to effectively a startup. And I thought, if we bought this printing business, they have a lot of customers that they've won independently of us. Maybe we can sell our digital solution to those customers. So it was like a two-pillar approach of why this made sense for us.
Mm-hmm.
And we started to figure out how to go about doing that. And ultimately, as we were going through that process of, first of all, me educating myself on M&A and, how to value a business, how to even make an approach to a business about buying them, I convinced myself that this was the right thing to do. And in the fear that our current partner mightn't want to sell, I found another business in the UK that I thought would be a good fit as well. And we effectively ran a process with both of those businesses, assuming one of them would fall away, but ultimately they didn't. And we acquired the two of them in sort of July and August 2021.
July and August 2021. And you said that it basically took you from this kind of decision to go down this path 2 years you told me on the pre-call. I'm not sure you said it here. So really the strategic decision was made in 2019 and it took you many, many months to actually execute on it. But execute on it, you did, and it worked.
Yeah, because my first protocol when I had this idea is I thought, well, I'll go and speak to EY, I'll speak to Deloitte, and I'll ask them if they could help me to pull this together. And they really weren't interested because we were a 2 million revenue business with 200,000 in profit, trying to make an acquisition of a business considerably larger than us.
Yeah.
And they just said, no, this deal size was too small for them. But I learned a lot through the process. And whilst I was pitching to Deloitte, Deloitte were the only, I met a guy in Deloitte who kind of took me seriously and met me and would have a coffee with me and shared a lot of value. I ultimately said to him, why don't you just leave Deloitte and come and join us as CFO and help me pull all this together?
Oh, wow.
And in fairness to him, he decided to take the risk and jump ship. And so Shane left Deloitte, joined us as CFO. And he was very well connected because he was a corporate finance guy, or an investment banker, I suppose, as you guys would say.
Mm-hmm.
And he basically helped us to raise the money and to buy those two businesses in 2021. So it took me a while to get there,
The 2 years, this taking you a while to get there, many people listening, part of the reason they're listening is to learn how to buy a business because they don't know, and it's a skill set unto itself.
Yeah.
Is there any takeaway, any distillation of those 2 years that you can share with the audience about, coming at this from a cold start, coming at figuring out how to buy a business from a cold start? Maybe the takeaway is hire a guy who knows how. Well, find your Shane.
Well, it's funny, because even before I had the confidence to go and approach an EY or a Deloitte, I knew nothing. My knowledge of finance was I could reconcile the bank on zero. And I probably wasn't very good at that either because I always lost the receipts, right? So that was the extent of my finance acumen. So I go to Google and I type in how to buy a business, right? Or how to value a business. Because I had approached our partner at this stage and they said, make me an offer. So I'm thinking, how much do I offer? How do I go about this? And Google said businesses are, let's say, in our space, valued on a multiple of EBITDA. I'd never heard of EBITDA. What does EBITDA mean? I didn't understand the answer, right? I was so rudimentary in my knowledge. So what I did, actually, I went and I hired what we call grinds. It's like a tutor that would give you help college kids pass their exams. And I reached out to a number of them and I said, look, I need a crash course here in the basics and in finance, and I need you to explain EBITDA to me, and I need you to explain why that's important. And most of them told me to take a hike, and that's not at all what they do. But one guy from the Philippines decided he'd take me on. So I spent 2 hours with him, and he gave me enough information to be dangerous. Basically, he explained the very basics to me so that I didn't feel like a chancer when I was having these conversations. Like, I understood what these key terms mean, and that was enough. Like, it's not rocket science, really. It's really not rocket science. So once I understood what EBITDA actually was and why it was important and why businesses were valued on a multiple of EBITDA, I had enough then to understand potentially how much I could borrow on this business, and would the cash flow of the business be enough to pay back the borrowings? So, that's really all I needed to know.
Yeah.
So
the LBO, the leverage buyout kind of fundamentals.
Exactly. And then I had a million conversations, like anybody I could meet, whether they were an accountant, like the lawyers that we used, anybody and everybody I would approach and say, this is what I'm thinking about doing. Any advice? What do I need to know? And people are generally just want to be helpful, I think. And they would introduce me to somebody else who was doing M&A. And I was just like a sponge. I just tried to pick up as much information as I could. And then as we were going through the process of acquiring the business, like, I really just immersed myself in it. And it's amazing how much you can learn in a very short period of time.
And what did your, frankly, compensation package to Shane look like? Both your pitch and your compensation package, because great that you kind of explained to us how you were an autodidact to figure this stuff out. But Shane was really the one who, I guess, made it happen, I gather. And so for the audience listening, let's say they go through educating themselves, the self-education, but it's got to be just an enormous lever to bring in a Shane. What did that conversation look like?
So I suppose from all of the conversations that I was having with this guy whilst he was in Deloitte, I could see he was generally interested in what I was trying to do. He was adding a lot of value for free, essentially, right? And I could tell he seemed to be quite passionate about it. And I just asked the question in a roundabout way, like, do you never get frustrated pulling all these deals together and not been in the mix, He says, oh yeah, no, I'd like to do something myself one day. I said, well, why don't you come along and get involved in this one? And he was well aware of where we were in our journey, and in terms of what we could, like, it was a massive stretch for us to take on his salary, but ultimately we had a number of early angel investors in the business who'd put, they may have had 5% of equity between them, and we were going to buy them out as a part of this acquisition. We were going to do a refinance and buy them out. And I basically said to him, if you can pull all this together, we make the acquisition, buy out these angels, we'll give you their equity. So there's a 5% equity stake in it. And I think that was enough incentive for him to jump ship. Also, thankfully, in Ireland, we have a government agency called Enterprise Ireland that's been set up to promote Irish businesses. Because we're a small island nation, we need to export, and Enterprise Ireland help to scale Irish businesses, and there's a lot of grants and supports. So they have a grant called a Key Manager Grant. If you're taking on like a really senior person that's going to have a transformational change on the business, they'll cover 50% of their salary for year one. And so that just made it so much easier for us to make that leap. So we availed of that. We were clever with the equity by buying out some of the angels, which means we didn't get diluted ourselves. And then Shane took a risk too, and we just were able to work together to pull that off.
Well, also perfect alignment for him to refinance in the right way, because he's basically refinancing his equity piece from out of their hands and into his. Not that, I mean, everybody, but he's really, that's his stake that he's sitting there negotiating, trying to figure out how to refinance. around.
The only other thing I'd say on that is none of the main, what we call pillar banks in Ireland, the key high street banks that everybody would know, none of them were interested in talking to us because they thought that this was too risky. You know, a small business with a very small net profit acquiring a much bigger business. So it was going to be very important. Sort of personal relationships were going to be very important. And because Shane had been active in that space for quite a long time, he had a black book and he knew a lot of people that could help us to pull it together. So I think that was critical to the whole thing.
Yeah. And you were able to pay with the Enterprise Ireland grant, you were able to pay him market?
Yes. Yeah.
Mm-hmm. Great. And Nick, this concept that you guys are really very small, buying a larger business, is a little bit of a reversal of the typical. Now, it certainly happens, but usually we hear of a larger platform doing bolt-ons and tuck-ins of smaller businesses. But just to spoiler, the trajectory of your growth here is you're always buying bigger businesses. From a minnow to a fish to a whale sort of story here, everybody. It's incredible. Anything to say on that theme? Or maybe as you were undertaking it the first time, because I guess kind of completing this first transaction, which the audience can tell that you do, probably gives you confidence that going from buying a bigger business as a smaller business isn't crazy because you were successful at your first attempt at doing so. Anything to say on that theme? Maybe
that is the common approach to, buy a platform and then have like a number of bolt-on acquisitions. I didn't know that. So I suppose we acquired what we seen in front of us, what we thought made sense. Absolutely, I can see why that's the common approach. But for us, it was more of there was no strategy behind it. This was the printing partner that we had. This was the problem we were trying to solve. And then because of that first experience of buying a business that was, multiples the size that we were, and we did that and it succeeded. The next time we look for an acquisition, you just kind of want to look for a bigger one and a bigger one. And that's just the approach that we've taken. And we've always tried to level up every time we do a deal, I suppose. Yeah. Well, there's something in that and it has worked for you. Take us to the other side of that and then what the next chapter looked like once you made these acquisitions and digested them. Yeah. So in 2021 now, and not all the numbers I'm giving here are pro forma. So they assume we have the business for, the full 12 months of the year. So in 2021, we jumped from 2 million in 2020 to 14.4 million in 2021. And EBITDA jumped from 200,000 in 2020 to 2.6 in 2021. That's because we made the two acquisitions in 2021. So we acquired them both using fully debt funded. So we took on 4.7 million in alternative debt, as we call it. So it's like, don't know if you have the same term, but it's basically like venture debt. So extremely high interest product where you have, drawdown fees, high margin, so the exit fees, and all in all, the margin on that when everything was considered is probably about 20%. Margin meaning the interest rate. Yes, margin meaning the interest rate, exactly. When all fees are included. But we went into that deal. And Shane, your resident expert, advocated this? That strikes me as highly risky. Well, look, put it this way. When I'd go online and I'd go to Bank of Ireland and I'd say, what are their corporate lending rates? And it'd be 3% at the time or something. Right. And then, this term sheet comes in with 14%. And then when you add in the entry and exit fees and everything else in the middle, it's like 20%. But the only people that would talk to us were non-bank lenders, as we refer to them, these kind of private credit guys. Yeah. Because of the perceived risk profile. But when we modeled it out, the way we structured it was that there was only so much of the debt that was amortizing. A lot of it was a bullet payment at the end. So the cash flow from the business could more than cover the debt service cover ratio was good. But it was still a pretty scary prospect, I have to admit. Particularly, this is our first time taking on, any meaningful debt, and we'd taken on nearly €5 million, a high interest debt. But we'd gone through our diligence. We had good advisors helping us. We'd modelled it all out. It all stacked up, and this was in the middle of COVID. Like, I believe I was still at my kitchen table, signing for this debt, and I did have a moment where I sort of paused and said, "Jesus, am I doing the right thing here?" But ultimately, it all worked out. So,
and Nick, is this personally guaranteed? Is our phrase here in the States? It was not. Okay,
no. So, pretty much everybody we spoke to, and this is something Shane introduced, which looking back, I don't know if I would have had the foresight to do this, but straight away, any lender we spoke to said there'll be no personal guarantee signed here, and everybody kind of agreed to it and signed up to it. In Ireland, because of the financial regulations, if I'm correct, only the core banks that are regulated by the central bank here, which is our financial regulator, only those banks can request a personal guarantee. Non-bank sort of alternative credit funds, by law, they can't request a personal guarantee anyway. But throughout the life of the business, there's been times where we've been dealing with regulated banks and they've asked for personal guarantees, and we've always said no.
Mm-hmm. And you said Shane kind of starts the conversation, saying
he raised that. I never would have even known that was an option. If somebody if a bank had said to me, "You need to personally guarantee this," I would have just said fine, because I wouldn't have known there was an alternative to say no. So. Yeah, I think in 2008 in Ireland, a lot of entrepreneurs got crippled with personal guarantees, and even people on property here. We had a big property crash in 2008, as everybody did. Yeah. So a lot of people got really badly burnt with that. So I think there's a big move away from personal guarantees.
Yeah. And then Nick, how the bullet payment. So you've explained how the repayment was going to come at the back of the term, and the amortization schedule gave you a lot of room to actually not only service the loan, obviously, but even have some extra cash flow. It sounds like.
Yeah.
But those bullet payments, what was your idea with handling actually repaying the loan? It was going to be let's refinance. We'll cross that bridge when we get to it, sort of thing. We'll grow into it. Obviously, you were planning to grow into being able to pay those down.
Well, I think one of the important things that we haven't covered is we're buying these businesses for generally less than 5x EBITDA. So we were pretty confident that, like, when we spoke to the main banks, they said, if you brought these businesses together and you had integrated them, we would lend to a business like you at the size you would be if you had brought it all together. So we kind of backed ourselves that we'd take on this pretty expensive debt. We would integrate the businesses and we would go back to the main banks. And it was Bank of Ireland that we went to. And we had 12 months to refinance, or the exit fees jumped up considerably. There were really sort of unfavorable terms with this alternative debt.
Usurious is the legal.
But you know what? People often say that, but it was a great product. We're really happy we took it.
Yeah.
It solved a problem for us when nobody else would take it. It was riskier than a normal loan, and they need to get paid for that. And we were more than happy with it. And it was cheaper than equity, right? And I've recommended the same lender to a number of people who I've seen that have been in a similar situation to me. So it's eye-wateringly expensive, but they fill a gap in the market that there's not a lot of players in, and so they get paid for the risk. And I think that's fair.
Absolutely. Yeah. I don't mean to suggest that they were predatory in some way.
Sure. Yeah.
Nick, your point about debt being cheaper than equity, of course. Did you though consider outside equity as a way to finance these acquisitions?
No. And well, I absolutely considered it. I thought about it, but when I did the back of a napkin kind of calculation, I was thinking to myself, well, on the one hand, we're not a massive success story over the last 7 years. It's taken us a very long time to ramp up pretty slowly to our first $1 million in revenue. This probably won't be too appealing to a VC. Probably too small, almost absolutely too small for private equity. And even if we could find somebody to write an equity check, we'd be diluted away to nothing because we were buying, like €1.5 million of EBITDA. We only had a couple of $100,000 in EBITDA. It just didn't make sense. So we felt debt funding it was the way to go. And because of the valuation that we were buying the businesses for, I think it lends itself well to debt funding.
Mm-hmm. Yeah.
Yeah. So so that was 2021. So we bought two businesses. Don't know what we were thinking buying two businesses for our first day out, but we did.
Well, hey, opportunity knocked again, and you had to grab it.
Not only two businesses, but one in a different country, one in Ireland and one in the UK. So whilst it's our nearest neighbour, still added a layer of complexity. So we spent 2022 just figuring out what the hell we had done and trying to integrate the businesses together. We got to 19.3 million in revenue in 2022, 3 million in EBITDA, and successfully managed to refinance the debt within 12 months. So got that down to a 3% margin then.
Wow.
Yeah.
Wow. So you were psyched. Yeah, 3% interest. You were psyched at this point. So you emerge from 2022 having made two acquisitions, which was for your first timers here, two acquisitions, one of which was in the UK, not even in your native Ireland. You go from 2 million-ish of revenue to almost to 19, 3 million of EBITDA, and you get out from under these loans.
Yeah,
were bridged you through, but there were extremely high interest rates. According to this plan that the Main Street banks, High Street banks had said, if you can pull this off, we'll give you favorable terms, but you got to pull it off, integrate the businesses as you buy, emerge from those acquisitions as a more sizable, stable business, then we'll give you the loans at 3% interest or some more favorable rate. You did that. So you were pumped in January of 2023.
Absolutely. We were relieved, I think, is the honest answer. But it was pretty obvious to us that these were good cash flowing businesses with a lot of longevity. We added a good technology story to these sort of more traditional businesses, and they throw off very stable recurring cash flow. It's exactly what the banks wanted. So, they're in the business of giving out money. We ticked all of the boxes. We knew that we'd be able to refinance it. So we got it over the line. I think within a day of the deadline, or else the fees would have went up considerably. So we incentivized all our advisors and so on to get it over the line within the deadline, and they get a little bit of a bonus, and we pulled it off. Yeah, so it was really, really good.
Mm-hmm. And what's your head count or your org chart look like at this point, Nick? You've got yourself, you've got Shane. He's in the UK. He's in Dublin with you. Yeah. You've got your Polish technology guys in Warsaw. Poland, in Warsaw. Yeah. And so what fill out the organization for us? Is this a remote business mostly?
So, pretty much, like, I had a small office in Dublin where I worked from. So if we're talking about 2019, when we did our first million, for example, we probably had about 15 to 20 people at that stage, most of them based out of Warsaw. So it's software developers and data guys. By end of 2021, after the acquisition, we probably had 50 or 60 employees.
Including all of those at the acquired businesses?
Yes, including all of those. Yeah.
Okay.
So we trebled headcount over a couple of years, which was an experience in itself, because suddenly everything went from, we knew everybody on the team. It was very easy to communicate to, more layers and more people to manage. That was tricky, but so around about 60 people, I'd say.
But I'm also trying to understand, Nick, if this is basically, so you've got the tech team in Warsaw building tech. You've got you in Dublin, who's the leader, and now you've got Shane. But do you have, and then you've got all the people at the printing businesses that you've now acquired who are on site at their respective locations. But just in terms of is it just you and Shane in the office? Like, who's in Dublin is really what I'm asking.
So we took offices in the printing business in Dublin. So we have an office there. So we just moved in. And we run them as one business. Like it's not treated like as an outsourced print provider. It's fully integrated org structure where they are just a function of the Mailmetrics business.
Okay.
So we're based in Dublin in one of these print facilities. Our UK colleagues are based out of the UK print facility, and the Polish guys are largely remote in Warsaw, but we do have an office in city centre if we need it.
Okay. Okay, great.
Yeah. So,
great. So top of 2023, 19 million, great generous terms on a loan, 3 million in EBITDA. Now what?
Yeah, so 2022 was 19 million. So then coming into 23, we were getting the itch to do another deal. And we wanted to do something, which at the time we thought was pretty transformational. So found another business which was around 13 million in revenue. So we were 20, they were 13. We kind of treated it like it effectively doubled us in size. And we acquired that business in August 2023. Again, for less than 5x, fully bank funded. So we finished 2023 on a pro forma basis of 33 million revenue, 5.4 million EBITDA.
Oh, fantastic.
And that brought us, I think, to around about 140 employees at that stage.
And then what of the cross-selling strategy? And reminding everyone that you started essentially a SaaS platform, a software solution, if you will. And you had this notion that you could cross-sell, bring some of those print customers over to the digital. Was that playing out?
Yes, thankfully it was. So basically what we do is, there's 4 pillars. So when we look at our strategy, it's very simple. Pillar 1 is M&A. We acquired these outsourced transactional printing businesses. Pillar 2 is we onboard them onto our digital platform. So we call that tech enablement. Stage 3 is we try to move them away from transactional pricing to more SaaS-based pricing. And then pillar 4 is digitization, where we try to send more digital communications than print effectively. So we're trying to change the revenue profile and the communication channel to turn it from a print contract into a digital contract, and all the valuation improvements that, as you can imagine, that brings to the business. So we were...
I'm sorry, say more about that, Nick.
Well,
the valuation improvements.
So very simply, a printing business is valued in a certain way, and, it's discounted because it's print, versus, a software, a SaaS business, and a digital communication business, due to the fact that it's technology, would, naturally receive a much higher valuation than a printing business. So ultimately what we're trying to do is take the businesses that we buy from one side of the spectrum, so the print side, and move them along to the other end of the spectrum, which is digitization. So we can benefit from the arbitrage between the multiple that we buy at and the combined multiple that the overall business will be valued at. Because ultimately the businesses we're buying are communications businesses. They just have a very limited set of communication channels that they offer to their customers, i.e. printing and mailing a letter. So we're just offering their customers more digital communication options. And by virtue of that fact, we can take a print contract and turn it into a predominantly digital contract. And, that has pretty significant valuation improvements on the business.
And we've heard you say that you were buying the print businesses for 5x, less than 5x. And so for every dollar of EBITDA that you're acquiring for 5-ish X, if you can convert that dollar of EBITDA to digital, it will trade for a lot more. And there's arbitrage right there.
Yeah, let's say closer to 10.
Closer to 10. So just converting a dollar of EBITDA from the print end of the spectrum to the digital end of the spectrum, call it doubles the value of that dollar of EBITDA.
Yes, it's easier said than done, right? It sounds
Right.
like
Sure.
it sounds like an infinite money glitch, but it's not, right? It's easier said than done. But if executed on, yes, that's exactly it. Like if I could wave a magic wand, and if I could take a business that we've bought for 5x EBITDA or less and convert 100% to digital, which will never happen, the valuation would probably be worth even more than 10. The 10 is because it's a blend of both. But yes, that's essentially what we're trying to do.
Okay, thank you. I interrupted you. You were about to say about the next acquisition. So you're at the end of 2023. You're at about 33 million.
Yes. So the end of 2023, we've just completed our third acquisition, which brings us to 33 million in revenue, 5.4 million in EBITDA. Again, we refinanced our previous debt facility. We took out a new facility to fund this acquisition. And that brought us to a point where we were the largest player in Ireland, which we were pretty proud of because we were the smallest 3 years ago. And that gave us a bit of confidence then. We felt, rightly or wrongly, once we broke the 5 million EBITDA mark, it was almost like we moved into a different category, I suppose. In terms of the type of business, the type of investors or funders that might be interested in backing us. So we bought that business in 2023, and then again spent pretty much the next year trying to integrate it. They had their own facility in Dublin, so this was the first time we had to shut down an entire site, move 50 people across the city to a new location. To consolidate it into our existing premises. So there's a whole load of logistics in that. But what that acquisition gave us was, it gave us dominance here in the market, and it gave us access to banks for the first time, where we had traditionally worked with insurance companies. So that gave us some big banking contracts. And I suppose we were in a situation then where we were the largest provider in Ireland, as I said. Whilst there were other acquisition opportunities in Ireland, they were much smaller, and I suppose it's funny how acquisitions that you'd be very interested in at the start of your journey become less appealing the larger you get, because the time and effort that would be put into them would be the same time and effort as doing a much bigger deal. And because the fact that Ireland is such a small country, if we were going to continue growing at the rate we had been, we decided we need to start looking further afield for a much larger acquisition. So we started looking towards the US and the UK, and ultimately we found our most recent and our largest acquisition in the UK in 2024, which was, I suppose, our most transformative deal yet.
Well, we'll want to unpack that deal, but let's just understand the business here a little bit, Nick. What Mailmetrics, 3.0 is, and what you're building at this point. So it's the communications platform for businesses like utilities and banking and finance and insurance that send out transactional communication, so-called transactional communications. Your monthly bill, for example, to their customers, and which is, of course, legacy is print, and there's this shift to digital. Your growth here is about buying these print shops, but print is going away. So you are buying businesses that have headwinds against them.
Yes.
It's basically a slowly dying, might be strong, but slowly declining industry. But I guess the point is you're playing both sides, because you're also the digital solution. So you're not really losing there. But just talk to us more about how print shifts to digital and how you think about this whole play. Is there not some loss in EBITDA to you when you convert a customer, a utility, an insurance company's customer, from paper to digital? Is there not some loss in EBITDA, or do the unit economics get less interesting to you? I'm reminded of when newspapers went digital and they were going to lose all their print advertising, and they were saying, "Oh yeah, but we'll just have all the eyeballs on our website and we'll make it up that way." But it was not a one-for-one trade. They could charge a lot more to sell a one-page ad in their printed newspaper than they could a banner ad on the website. And so there was a major contraction in revenue, of course, which ended up being fatal for many of them. Not suggesting that here, but it's not the EBITDA per customer is not a one-for-one trade as they shift from paper to digital. Or am I wrong?
I think we have what we think is quite a unique model to address that problem, which I can't share too much about, but essentially we deliver our solution as a fully managed service. So we don't just give our customer a software license and tell them to go off and figure it out, stand this up yourself and, get some value from it. We work with the customer and deliver it as a managed service. So, and I'll come back to why that's important. If we look at it on a unit basis, so if you send a bank statement, it might cost you, and I'm using just example numbers here, it might cost you $3 to send a bank statement, for argument's sake. $2 is the cost of mailing it, so the USPS fee, and $1 is the cost of printing and enveloping it and sending it out. What we're trying to do for the customer is to save the postage fee, because we still get our revenue, they get the benefit of saving the postage, and it's the postal system that loses out. And we've essentially created a model whereby we give our customers our technology as a part of this managed service that we offer them, which allows them to massively reduce their postage spend, which is generally 2/3 of the overall spend that they have. And in return for that, we get a better margin on the digital side. And that's what allows us to give them the technology for free as a part of the managed service. So we get paid back for giving them that technology over time, basically.
Great. So from your perspective, as you transition a customer, we should really say one of their customers, one of the insurance company's customers, from paper to digital, they're getting a tremendous amount of savings, and you're still getting margin, maybe even better margin.
Yes,
yes,
correct. Yes.
So you're seeing margin expansion and the aforementioned multiple expansion from the quality of revenue going from a print to digital.
Yes, that's the idea. Yeah.
That's very powerful.
Yes, and again, that's something we didn't have a grand master plan necessarily. We kind of stumbled across some of this as we went along. We realized that there's a number of value levers that we're pulling here as we as we educated ourselves a little bit more on how businesses are valued and what might be interesting to an investor, and the whole kind of equity story that we're building here as we're going through acquiring a business and transforming them over time. It's a pretty powerful model when it works, and that's why we don't need it to work 100% for every single customer for an acquisition to be successful.
And the it that we're referring to now is converting all their customers from paper to digital. As long as the more the better, but it doesn't need to be 100% of their customer base, nearly 100% of their customer base, for it still to be a worthwhile, even interesting acquisition.
Exactly. Like the third acquisition we did in Ireland that brought us from 20 to 33, we really bought that business for 3 customers. And now all 3 of those customers are on our platform sending digital communications. And for that alone, it was worthwhile. Even if every customer left, it would still be worth it for those 3 acquired customers.
Wow.
Yeah. Incredible.
Well, Nick, we're bumping up on time here, so let's close out with hearing about the acquisition of the UK business, the details of that acquisition, and then kind of what the plan is, what the big picture plan is here. So to that acquisition, what can you tell us about how it went down?
So we finished 2023, 33 million in revenue. We were snooping around for acquisition opportunities. I was spending a lot of time in the States. If you had have asked me in December 2023 where the next acquisition would be, I would have told you it would have been in the US.
I did, because that's about when we talked the first time, was late 2023, and you were talking about coming over here.
So there you go.
Yeah, you did.
So got wind that we were looking around, and the business that we ultimately acquired, we had spoken to in the past, but there was a process ongoing for that business to come to market. We ultimately got involved late, and they had just gone exclusive with another party, and so we missed the boat. And I said to the guy selling the business, the investment banker selling the business, let me know if this doesn't work out, and I will ultimately, I'm interested. I'm here. I can get up the curve pretty quickly. And I think that didn't, so it definitely didn't go to plan, right? Because we ended up buying it in the end. But every month on the anniversary of the day that they went exclusive, I just emailed to say, look, I'm here, still around, I'm still interested. Don't forget about me. And he would never respond to any of my texts or emails. Until one day I was flying home. I was on an airplane. I can't remember where it was coming from. And I said, it's probably about time now to follow up again. And by the time I landed, I got a text message from the guy which basically said, can you chat? So,
oh, wow.
So I knew it'd fallen out of exclusivity. So I'm texting the lads and I'm saying, lovely, like this is back on the table. I think they've fallen out of exclusivity. So we pretty quickly got up the curve. And for context, this business was a much bigger business than us. It was around 180 million in revenue, around 22 million in EBITDA. And as a reminder, we were 33 million revenue, 5.5 EBITDA. So we pulled the team together really quickly, team of advisors, and decided we're going to put a bid in here. Now, there was a number of interesting things about the deal. It was owned by all the management had equity in the business, but the ultimate owner was a high net worth from the UK who wasn't involved in the industry necessarily, had a number of different assets and wanted to exit his portfolio in retirement mode, looking for estate planning and all that, which was all good. And they wanted to close within a particular timeline. We put an offer forward, which was very favorable to us, put it that way. But we'll deliver within your timeline. And we tried to give them confidence that although the valuation might be low, we are going to work 24 hours a day to close this deal this side of Christmas, essentially.
So you traded money for a certainty of close.
Yes,
and that's worth something, especially in this case that they had their own deadline they wanted to meet.
Exactly. And there was looming changes coming in the UK tax system because it was a Labour government, and they were worried about capital gains tax, and there was all sorts of reasons why it would be favourable to close this deal by a certain date, and we were trying to.
Did you know that in advance, or only in retrospect did you learn that?
We knew little bits of information. They were telling us little bits of information as we went. And equally, we could only afford to borrow so much, and we only had access to so much capital. So when we were saying this is as much as we can afford to pay, right? So if that's not acceptable, we understand. We weren't telling a lie there. So if there had been any more negotiation, we would have walked away because we couldn't have closed. We couldn't have done the deal. So it's a nice position to be in when you're negotiating, because you know that you're literally, that is my best offer and I can't move from it.
Yeah.
So we went to our banking partner. The check was too big for them to do it alone. So they brought in another Irish bank to have a club of banks to support the deal. Although we probably could have bank funded it, the banks were too nervous because, again, it was a big acquisition. They seen it as very risky. They're very conservative anyway. So they wanted us to have a slug of equity coming in from a PE fund. So we were trying to raise debt from two banks, raise equity, keep all the balls in the air to make this deal happen in a relatively short period of time with Christmas on the horizon, so we were trying to get it done before Christmas 2024. And ultimately, somebody said to me at the start of it, oh, this is a double deal. This is going to be really difficult for you to do a double deal. And I said, what does that mean? I said, well, you're taking on equity. So they're going to be diligencing you, and then you're making an acquisition, so you're diligencing them, and ultimately your PE guys are going to want to diligence the business that you're buying too. And it's just complicated to keep all the balls in the air. And I was like, it'll be fine. And then when it was done, I said, I'm not sure I'd ever do a double transaction again, because it was very, very, very difficult. It nearly killed us, to be honest with you. It was a very difficult process, but we pulled it off, and we raised the debt, we raised the equity, and we closed the day before Christmas Eve, which meant that we closed last year with 210 million in revenue and around about 27 million in EBITDA. About 640 employees now across Ireland, UK, and Poland. So wow. It was a transformational deal. Now, we've said that a couple of times, but this one really was transformational. It puts us in a totally different ballpark. We were the leader in Ireland by 2023, market leader. We're now probably second in the UK, also. So, yeah.
And when you talk about being second in the UK, leader in Ireland, do the competitors have the digital platform, or that you also have, which of course is the longer term play, the real kind of multiplier in your entire play? Do your competitors that you're referring to even have that, or are they just these traditional legacy print operators?
They will all claim to have some digital capability, and they do, right? In fairness to them, and some of them are really good competitors, and they compete well against us. But mostly they will acquire some third-party technology and integrate that into their workflow. Whereas we develop all of our own technology. It's a product that we've built up for 10 years. It's their own platform, which could be sold independently to the service offering that we provide. So I think there's a distinction between you purchasing a piece of software and selling that to your customers as a service that you provide, and building your own IP, which I think really changes the proposition, because what we have is totally unique and nobody else can copy it, whereby a lot of our competitors are all buying the same software and selling the same software to their customers, if you know what I mean. So they're not differentiated in any way.
They're not even. It's not even their own software. It's
not
a white label solution.
Software. It's a third-party product that they're purchasing. Now, I'm generalizing, because there are some that are like us, right? Not so much in the UK and Ireland, but there are some businesses out there like us that have their own technology, and they're really strong at what they do. But if you look at the industry as a whole, it's not common. And it's very difficult to go from being a printer, although there's a lot of technology involved in these businesses, to building a software team and building a platform. It's a very difficult mindset shift. Rather than being a technology company and ultimately buying the print capability,
Yeah. So just to underline where you are today, you are, what you just said, you're pretty differentiated in the market. Yeah, yes, you've got couple other guys out there who do something similar, but really it seems like in terms of a digital forward transactional communications business serving the biggest kind of finance type businesses in the countries, you guys kind of stand alone. You're the best in class. You've got that going for you. So for strategic acquirers, maybe you've got real scale, real size now. I mean, you are at north of 200 million in revenue, a solidly middle market business now. I guess I actually don't know what the strict definitions are. But what did you say? You're 25 of EBITDA. Did you say
about 27?
27 of EBITDA. And you've got this direction over time where you're, incrementally, gradually shifting the EBITDA dollars from a certain valuation to another, converting these customers, the end customer, the homeowner, from print to digital. And so that your EBITDA value on a dollar per dollar basis is just kind of ticking up with every conversion that you do there. It seems like a very valuable place to be sitting. Do I have all of that right?
Yeah, pretty much. Yeah.
And so what does what is the grand plan now? More of the same, or coming into the US, looking at other markets, or what?
Yeah, I'm flying to the US tomorrow. So you're my last call of the day before I get ready and pack my bags to go to the US tomorrow. Yeah, so generally we are I see a very clear path to us doing $1 billion in revenue. I think if we just keep replicating what we're doing, we said that when we were probably $1 million in revenue or a couple of million in revenue, and people kind of laughed, but 21% of the way there now, it's probably a lot more realistic. And if we continue to buy bigger businesses, or even businesses of a similar size to us now, it's not, it doesn't take a huge stretch of the imagination to see how that can happen. However, I think we will probably expand our horizons in terms of the types of businesses that we are buying. We're of a size now where we can probably afford to start looking at some more technology businesses to complement our offering and not just be focused on buying the customers to convert to digital. Because ultimately we have over 400 customers now. There's a lot to get through there. And, we'll probably start to expand our horizons in terms of the type of profile of businesses we acquire going forward. Not that we'll totally change strategy, but there are areas where, we could probably acquire in some further skill set. But yeah, definitely more M&A in the future. We will continue to grow organically in the markets we operate today. We absolutely want to expand further afield. I do see us entering the States at some point in the future, hopefully the not too distant future. And we're really just enjoying the journey, to be honest with you. It's been a whirlwind for the last 3 or 4 years, and we're just really enjoying it, and long may it last.
Long may it last. And Nick, any takeaways from your story? I mean, it's so, you were a struggling minnow of a software business, tiny and struggling. It wasn't even, I mean, you were kind of on death's door, not kind of, you were. And then you're at 200 million in revenue. It's, stories like that are very idiosyncratic. So I'm not sure that you can generalize takeaways, but would you try?
Yeah, I think 2 or 3 things stand out. Resilience is a word that I think we throw around a lot. I think it took a lot for us to just keep showing up in the early days and just knocking on doors until an opportunity presents itself. All of these moments in our story where we got lucky, and we genuinely did get lucky, but our eyes were open for a bit of luck, if you know what I mean. We were out there and we were active despite things being pretty bleak. We kind of always kept the chin up when we were looking for opportunities. So I think that resilience in the early days was crucial. And I think that culture has kind of stuck with the business now, which is great. I'm a firm believer in the, if you think you can or you think you can't, you're probably right sort of mantra. And I really believe in just backing yourself. And I think if somebody else can do it, you can do it. And that really applies to the phase where we were trying to figure out how to buy a business. And I thought, I have no business been in this room. You know what I mean? I don't know what I'm talking about. I'm not qualified to have these conversations, but all you need is a little bit of information to be dangerous. And you can get up the curve pretty quickly. And I think don't rule yourself out just because you don't have the information that you think you need to have. Just get started and put one foot in front of the other, because I think it's incredible what you can achieve if you just set your mind to it. And I think that's very true in our story.
Yeah, I agree. I love that takeaway, and I fully agree. Great, Nick Keegan. Well, let me let you go to pack to come over to my neck of the woods tomorrow for what may be your first acquisition in the US. You didn't say that. My words, my assumption.
I didn't say that.
Congratulations, obviously, on your success, but particularly because of really the themes you just said of not being scared off by not knowing what you were doing and pushing through. There really is a lesson in particular for our audience who are tuning in to learn and probably feel overwhelmed at a lot of times as they go down their own paths. A lot of inspiration to take from your own. So thank you very much for sharing it with us, Nick Keegan.
No worries. Thanks, Will. Really appreciate you having me on.
Hope you enjoyed that interview. Don't forget to subscribe to the Acquiring Minds newsletter. We send an email for every episode with an introduction to the interview, a link to the video version on YouTube, and soon, key takeaways, numbers, and more essentials from the interview for those of you who don't have time to listen or watch it. Subscribe at acquiringminds.co. You'll also find all our webinars there on the website, both those we have coming up and recordings of past webinars. At this point, there are over 30 webinar recordings, a wealth of information on all the technical nitty-gritty of buying a business. acquiringminds.co.